Hi, James Good with an On the Money Market update for Tuesday, the 8th of January. Now, my thoughts on the longer term direction of the markets are percolating at the moment, so meantime, I thought I'd draw your attention to a short term trade I'm looking at, which I think has a good chance of success and a very decent risk-reward profile. Now, I mentioned on Twitter last Friday that I thought the huge New Year's Day gap up in the indexes would close. I think that's nailed on, and I'll tell you why in a second, but I'm also recording this today because we're at the point where the ratio of risk to reward is probably just about as good as it's going to get. The TRIN is an indicator I rarely use. Many swear by it. It's been around for nearly 40 years. And basically it compares two ratios. One ratio of the number of advancing versus declining stocks, and the other, the buying and selling volume flowing into those stocks. When you get a very low TRIN reading, it means there's far more volume going into the average rising stock than there is going into the average declining stock, and vice versa. Now, on New Year's Eve, the first of the two recent big up days, there was a huge volume skew into stocks that were going up. One of the 11 most extreme since 1950, according to Sentiment Trader. Now, this kind of information, where you get an extreme on an indicator with a very long history, tends to be reliable and can be very useful for coming up with trading ideas. Now, here's why. When the buying volume is so extremely skewed, it just can't be sustained unless something truly exceptional is happening. So let's look at each of the 10 previous comparable TRIN readings. A surge of buying interest here. The follow-through lasts for 4 days before all those gains are wiped away. 1955, sudden correction, buyers step in, but the follow-through lasts a day before all those gains and more are wiped away. 1957, blast off after a bear market. The bulls pushed the market higher for 5 more days until all those gains were wiped away. 2003, blast off at the end of the bear market. This time 4 more days was all the Dow could muster before a nasty sell-off. This time, though, the entire gain was not wiped away, as you can see from the SPY chart. Here's the same day on the SPY chart, and you can see that 76.4% of the gain certainly was wiped away. 2006. The gains, in this case, didn't even last a day. 2008. In the depths of the bear market, the gains didn't even last 5 more days before le deluge. 2011. 2 historic readings almost back to back. QE in effect. From the first of those to the turnaround took 7 trading days, and both gaps were mercilessly closed. So in 8 of the 10 cases, the gap began to close within 7 days, but there were 2 unusual examples I deliberately skipped. Let me show you. First, 1982, the kickoff to the greatest bull market in history. Bullish sentiment was absolutely smashed, valuations at multi-decade lows. Hardly surprising the market didn't pause here, but that's not the situation we find ourselves in today. Finally, 1990. Here it took 45 trading days to hit the reversal point. But boy, what a reversal. 22% downdraft as stocks priced in the first Gulf War and the recession. But there was extreme bullish sentiment in the lead up, and that was combined with a short covering rally in the classic profile of the 3 peaks and domed house pattern, which we've looked at so often and which some indexes are in the grip of today. So here we are, 3 days following the TRIN signal, or 4 days following the TRIN signal, with a yawning gap to 1425 on SPY, resistance from the old highs right here, heading into an uncertain earnings season with corporate profits at historic levels and poised to revert to the mean, and the debt ceiling debate just warming up. Seems to me the chances of this gap closing are very good, either from here starting imminently or from a slightly new bull market high with even better risk reward.